We're going to look at options in this class, and particularly how options impact corporations. First, we're going to discuss option basics and some terminology relating to options. There are a lot of corporate securities that have features that are similar to the financial stock options that are traded on organized exchanges. Most of the time that a corporation issues stocks or bonds, there are option features associated with that issue, and we can look at capital structure and capital budgeting decisions in terms of options. What is an option? An option is simply the opportunity to choose among alternatives in the future. The more time you have to make that choice, the more valuable the option is. The more uncertainty there is, the more valuable that option is. Value could go up or down a lot. More new information is going to lead to better decision making, and the alternatives the more alternatives there are to choose from, the better are your options. Financial options are the ones that you'll see listed in the CBOE, Chicago Board of Option Exchange. The option to purchase or sell a stock before some specified date at a pre-specified price. That exercise price or not exercise, it's an option. You don't have to exercise that option. For example, see the prices of some options on IBM stock in March 2023 at this link. You can pause and look. Real options are options on real assets as opposed to on financial assets. The point of this course is not to make you an expert on option pricing, but to help you to identify options, to have some basic insight into valuing options, and as a risk management tool. Options are everywhere. There are traded options, some non-traded options. Many companies give employees options to buy the company's stock. There are many investment opportunities, which are real asset options. You'll see options that are embedded into securities. For example, convertible bonds have a stock component and a bond component. The option to exchange your bonds for shares at a pre-specified price and time. Some people think that derivatives are risky. They can be used in a risky way, or they can be used to reduce risk. At PSFS, I hedge the risk in our bank's portfolio, primarily by using derivatives. Derivatives in and of themselves are not bad or good. It's how they're used. A call option gives the holder the right, but not the obligation, to buy a given quantity of an asset. A put option gives the buyer the right, but not the obligation to sell a given asset on or before a given date. If you think the asset will rise in the future, you may buy a call option on that asset now. Put options give you the right to sell at a specified price. Here you're betting, well, maybe more likely the price is going to go down, so I want to lock in a higher price at the strike while I can. A call option is like the leverage purchase. In other words, the purchase with debt of the underlying asset bundled with insurance. You need very little cash down today. A call option premium generally is very low compared to the asset value. What you're doing there is limiting your losses. That's insurance. That's why we buy insurance, to limit our losses. A put option is like insurance. If the underlying asset goes below a particular price, you can sell at the higher strike price and you will lock in your gains. The price at which you can buy or sell the underlying asset by exercising the option is called the strike or exercise price. The option premium is the price to buy the option. The time value of an option is waiting for more information. Maybe I don't know whether the price is going to go up or down. I'm not willing to bet a large amount of money the price is going to go up for a call or down for a put, but I'd like to wait and see. I want to buy more time. And it's a right to buy or sell at my discretion. I don't have to buy or sell now. Options are very much a zero-sum game. In other words, if I win with my option purchase, then the option seller loses. There's a set amount of money and we're placing bets on what's going to happen in the future. To exercise an option, that's the actual act of buying or selling the underlying asset at the strike. Then I say I'm going to buy this share of stock using this option. The strike price or exercise price, and those terms are used interchangeably, are what I have to pay in order to fulfill the option contract. Expiry, that's the maturity date of that option. European options can only be exercised at the expiration date. American options can be exercised at any time up to the expiration date. And as you can imagine, an American option is going to be a bit more valuable than a European option because I've got more options. I can exercise before if I think prices have gone up enough and now they're going to go down. Then I want to exercise my call option early. The intrinsic value is what the option is worth today if I decide to exercise it. Some other option terminology is on this slide and on the next one. In the money, for a call option to be in the money, the market value of the underlying asset is greater than the exercise price. I would have a positive payoff if I exercise my call option right now. At the money, the two prices are equal. The exercise price and the current price are equal. Out of the money, with an out of the money call, the current asset price is less than the strike. I wouldn't want to exercise that call option. I wouldn't want to pay more for something that's worth less. Option pricing is an achievement in financial theory. The biggest model is the Black-Scholes model. In 1997, Scholes received a Nobel Prize. Black would have, but he died before the prize had been awarded. This slide shows the formula to value a call option using the Black-Scholes model. You can pause the video to read it. The next slide, which is from your textbook, illustrates the cumulative normal distribution, the probability that an outcome from a normal distribution will be below a certain value D. The left part of the curve and the right part till the point D is shaded and labeled N of D. Warren Buffett has called financial options weapons of mass destruction, but he did not say options were bad. He owns options. It's how you use the options that matter. Orange County, California, lost a lot of money using derivatives. Use options only if you know what you're doing.